Do you want to maximize your crypto gains? Well, if you do, then you really need to be familiar with on-chain indicators. In this video, I'll outline the top 10 indicators that will give you a huge advantage in this cycle. I'm also going to be revealing the market indicators I'll be using to help me with my crypto cash out strategy. This will be at the end of the video. By the way, nothing in this video should be taken as financial advice. I'm literally just trying to help you with my 7 years experience as a crypto investor. All of the indicators on this list are on chain, meaning they come directly from the data recorded on a blockchain. This data helps us to determine the underlying health and activity of cryptocurrencies. And with this information, you can make educated guesses about future price movements, and this means potentially huge gains. The first indicator is daily active addresses. These are unique wallet addresses that have been active participants on the network, like the Solana network, within a 24-hour period, either sending or receiving funds. Each of these addresses can be tied back to individual users or collective entities. But why is this important? Tracking the activities of these addresses across different cryptos can reveal a lot. It's a bit like seeing how many football fans are in the stadium on a Saturday afternoon. It will give you an idea of the football team's popularity and a little indicator of how well the team is currently performing. When you look at the growth in the number of daily active addresses, there's often a parallel we can draw with the asset's price. More active addresses generally means higher demand for a network services and its currency. As this demand increases, it can lead to an increase in the currency's value, which is why keeping an eye on this metric can be so beneficial. But it's not just about the price. The health of a cryptocurrency network can often be gauged by the number of these active addresses. A thriving network with lots of active addresses is a sign of a strong user base. On the flip side, a decline in active addresses might just mean the price is headed south. The second indicator is daily transactions and fees. Daily transactions represent the sheer volume of activity within a blockchain over a single day. Transaction fees are payments made by users to compensate miners for the energy and resources spent to validate and record transactions. Putting these two indicators together, let's look at the Ethereum network. When the network is busy, the fees go up, and Ethereum tends to get very congested, so the fees tend to get quite high. One of the reasons I prefer Solana is that the fees are so low compared to Ethereum. Both these metrics are very useful as they can help you gauge a crypto's present state and its immediate demand and possibly predict price swings. Even though the fees are high for Ethereum, at least you know the demand is there because the network is busy. There's plenty of activity and people are using the network. Even though I've got serious confirmation bias with Solana, this network is not without its issues, like the fact that the amount of transactions were that high that the network suffered outages earlier in 2024, around February time I think it was. This isn't ideal by any means, but again, at least you know the network is popular, and I'm very confident that the Solana team will get it right, and the project will go from strength to strength over the next few years. The third indicator is exchanges supply. This is a number that tells you how much of a crypto is currently stored on an exchange wallet. So then why should you care about this metric? Well, it's all about understanding what might happen in the market. If there's a lot of a particular currency on exchanges, it could mean that people are about to sell, which would obviously lower the price of the coin or token. This is because crypto holders typically transfer their assets from hardware wallets to exchanges before they sell. Just as a large amount of a particular coin or token on an exchange could signal sales, the opposite is also true if there's not much of that particular asset on an exchange. This suggests people are not about to sell, but are in fact holding on for dear life. This can be indicative of a future upward price movement. Just be aware that the safest way to store your crypto is on a cold hardware wallet, not on an exchange. And you can get exposure to crypto without having to use exchanges or wallets if you prefer, like buying stocks like MicroStrategy or Coinbase, for example. The fourth indicator is MVRV, or market value to realized value. Think of this indicator as a thermometer for how heated the market is about a particular crypto. Here's how it works. MVRV compares the current market price of a crypto to its real value, what it was worth when it was last moved on the blockchain. You can figure this out by dividing the total market value, which is what people are willing to pay right now, by the realized value, which is more like the historical price tag of all coins in circulation. So it's a measure of how much more expensive Bitcoin is relative to when it was first potentially bought. Now this ratio is useful. It's like a reality check that shows us if a crypto is potentially overhyped or maybe a little bit under the radar. MVRV is above 1, the market might be getting a little too excited, thinking the coin is worth more than its historical average. Historically, an MVRV above 3.7 indicates a price top, but an MVRV below 1 could be a sign that the coin in question is undervalued. The fifth is potential market top, bottom indicators. First off, we've got the net unrealized profit to loss. It shows us difference between what everyone's crypto is currently worth versus what they paid for it. When this indicator gets really high, it might just be time to sell. If this indicator is low, the party's just getting started. The markets are probably at a low point, and this is the time to buy. Then you've got the percent of addresses in profit. It's quite straightforward, as this metric looks at the percentage of investors who are sitting on gains with their crypto at today's prices. If nearly everyone's making money, then be careful, as the market might be overvalued and it might be time to sell. But if it's the other way around, the market could be undervalued, so it might be time to buy. Another metric to look at is relative unrealized profit to losses. This one is all about timing. Like if people cashing out slowly as the market cap climbs, always seeing escape to the exit. The sixth is the miner's revenue. Think of miner's revenue as the heartbeat of blockchain networks. Like Bitcoin, this is all about the income miners receive for keeping the network secure and transactions ticking over. It's a number that tells us whether miners are making money or just scraping by. But how do we keep an eye on miners' revenue? Well, there's numerous tools out there, from blockchain explorers to market data crunchers and profitability calculators, that will give you the lowdown on how much these digital miners are actually making. So why should we care? Well, when miners are raking in the money, it's often a sign that the network is buzzing with activity. And if the network is buzzing, it's a sign that the network is healthy. It's a good sign. And we could see price action moving upwards. But low activity could suggest the opposite. But then again, it might also mean that mining is becoming too costly. If mining expenses start to outweigh the rewards over a long enough time span, miners might start to call it quits. And this is problematic. The seventh indicator is hash rate. The hash rate is like the horsepower of a blockchain network. It's a measure of the amount of computational power being expended to secure the blockchain and process those transactions. So why should you care about the hash rate? Well, it's a big deal for the network's safety. When you hear about a blockchain's hash rate being high, think of it as a good sign that the network is strong and secure. More computing power means it's harder for hackers to break in and mess with transactions. But mining does get harder when the hash rate goes up. And that's because blockchains are set to keep things challenging. As more people join in on the mining, this keeps the pace of mining steady, so new blocks don't start popping up too quickly. Another reason why a higher hash rate is a good sign is because it means that miners are deploying even more power and capital to protect the network. Remember though, miners want to make a profit. So if it becomes unprofitable for them to mine, then they'll simply switch off their machines. As they leave the network, the hash rate will drop. The eighth indicator is HODL waves. These waves are a really useful way to gauge when investors who have been in the game a bit longer believe the markets have hit a high point. HODL waves show three types of coins: lost or ancient coins, which are over 5 years old; coins between 1 and 5 years old; and young coins which are generally less than 6 months old. Now we know from past precedents there is a very low chance that coins over 5 years will re-enter the market. That's why they've classed as lost or ancient. But when you see an increase of old coins re-entering the market, it's indicative that these older diamond-handed investors are selling. And as basic economics tells us, increased supply with no change in demand can drive prices downwards. In other words, if you notice a rapid increase in the number of old coins hitting the market, prices could be about to swing. So keep your eye out for it. The ninth indicator is NVT, or Network Value Transaction Ratio. This is essentially the financial pulse check for cryptos, acting as a gauge for whether a digital currency is potentially overvalued or undervalued. To determine the NVT, you take the entire market cap of a crypto and then divide that sum by the daily dollar amount of transactions flowing through the network. The NVT is easy to track at sites like Glassnode and Coinmetrics. The reason savvy investors keep an eye on NVT is it helps them determine whether the crypto is well priced. Is it priced like a rare diamond or a common rock? A towering NVT might signal an overpriced market, while a basement level NVT could mean there's bargain to be had. The 10th and final indicator we'll cover is smart money labels. These are really useful indicators, an excellent way to get an edge in this game, in this crypto game. If you want to know people's agendas, you should follow the money. But if you want to know if the markets are about to move, you should follow the smart money labels. Smart money labels, as the name suggests, helps to understand what the most informed and influential market players are doing. These labels track various investors' wallets or addresses, and they don't just show the size of the holdings, but more importantly, reveal their investment patterns and market foresight. If you want to know what the best in the business are doing, smart money labels are the way to go, or one of the ways to go. So how can you track this? Well, again, this is where analytics platforms like Nansen come in. Nansen has a handy set of labels that help us spot the experts in the crypto trading world. These labels give us a glimpse into who's making smart investments early on and who's earning big from providing liquidity on popular platforms like Uniswap or SushiSwap. They also point out the investor wallets that seem to have a knack for making the right moves for the bigger players like investment funds. This is a label that shows us how they're spreading out their crypto investments. So while it's always better to do your own research before investing, your next best bet is to follow the smart money. This video is quite complex and probably not for everyone. I'm just trying to give you as much information as possible to help you in this crypto bull cycle. As a rule, I like to keep things simple as an investor, and I'll be keeping things simple with my cash out strategy. By the way, that cash out video or exit strategy, if you like, is coming up very shortly. As promised at the start, I'll be telling you the market indicators I'll be using to help me with my cash out strategy. I'll be using the 200-day simple moving average, the 50-day SMA, the 34-day exponential moving average, and the 9-day EMA. I'll be going into this in much more detail in that upcoming cash out video that you can find on my YouTube channel in the crypto section. That's it for now. If you've liked this video, give it a like and help me grow the channel. Thanks for watching.